Hi guys, we're here. We're here for the chaos. Light Azul. Come on, Jeff. Where's my water? Okay. I brought some kombucha with me, Jeff. Well, and the whole chat. Anybody want a kombucha? Oh my goodness. Who is ready to make some money? Let's go, Hugh. Where have you been? Where have you been? Unbelievable. Good to see you. Good to see you. Get some music. You guys want some kombucha? I brought some kombucha and some water. We could share that, Get some music, and then we have a party. Hello, everybody. Adventuring? That sounds amazing, Hugh. That sounds amazing. Where have you been adventuring to? So the FOMC, the statement comes out in 6 minutes, guys. Alrighty, so 6 minutes, we're gonna see the S&P react to the Fed rate cut. Ready for a 24-hour stream with the kombucha? Yes, I'm ready. Ready. Yeah, probably my favorite thing to drink now, kombucha. Some of it doesn't taste amazing, but it feels good. Yeah. Good afternoon, everybody. Happy Fed afternoon. Open has done really well. Open finally broke out. Obviously, we got slapped again, but that was a really good push to almost $11. So from 877 to 1187. So pretty sweet run. Good job, Tony. Tony was ready to cook this thing today. So the expectation is that the Fed will cut rates by 25 basis points, right? That's kind of what the market's priced in. So I think, again, like we've talked about today, right? The issue that we've had the entire time is the markets have been pumping for quite a bit now, pricing in the expected rate cut. So do we get by the hype, sell the news? What do you guys think? Do we go up or do we go down? What do you guys think? Up or down, chat? Up or down? ASST? He needs to buy more is what needs to happen there, Jeff. Told him to cut it or else. Let's go, Peter. You need to cut it. Yeah, cut it or else we will remove you next year, Yeah, so 25 basis points. I've seen some like some numbers going around that they might do 50 points as well, but it's going to be 25 points. I don't see the Fed being too aggressive, so I'm hoping that we cut and we go up. Right, that's my hope. We've had like mini sell-offs. We can't really call these sell-offs. Right? We've had like a mini retracement the last 2 days, and now you can see as we're getting close to the Fed statement or the minutes, we're pushing back up. Right, so almost like they know what's coming. Expectation more than anything else. Yeah. Would become a part of the unemployment stat. Don't worry, next year, Gary. Next year, he Powell is gonna be unemployed. Yeah. Okay, let's see. I'm looking for NQ. Where's NQ? There we go. Yes. Futures. It's interesting how they've split up. How they've split up their QQQX. Okay. How much time do we have? 2 minutes, guys. 2 minutes. There we go. No, in 2 minutes, Manvia. 2 minutes. Well, less than two now. Once they do, then we'll take a look. And yeah, here we go. Here we go. You can see the candles. When you see the candles moving in this direction, it's almost a bit scary, isn't it? You almost feel like it's gonna do the opposite once the statement actually comes out. So we're gonna get the minutes in less than a minute, and then Powell is gonna be on in 30 minutes. To kind of give us, the same usual speech. My colleagues and I, dual mandate, inflation 2%, right? Same rubbish. So we're just waiting now. Just waiting. Okay. Make sure I open up my news. Ooh, okay. Look at that cook. Look at that candle. Damn. Damn. Okay. Damn. See, I'm still not convinced yet. I'm not convinced yet. I'm not convinced yet. I'm not convinced yet. Maybe if I keep saying that, we're gonna keep going up. You know. So the Federal Reserve has cut rates by 25 points, right? Expected, yeah. This is kind of what we expected, and this is what the market was pricing in, right? So the market's getting exactly what it wanted, right? Getting exactly what it wanted. Ayo Azul, ayo, good to see you, Azul. How are you? Like I said, I'm not convinced yet. I'm not convinced yet. Buy the hype, sell the news. Unless we break above 666,178, I'm not convinced. In and outs. Did you make monies, Lauren? Did you get some calls, some zero DTE calls? Pizza, 30 points to get a new car. So now we're back to red, right? Like I said, I'm not convinced yet. I'm not convinced yet. Until we actually break above a brand new high, I'm not really convinced. Open is dropping with the markets, right? So the rates go down, open goes down. Nastiness. Sheesh. So we said this earlier today, right? Open is going to be sensitive to the rate cuts, right? Open is sensitive to rate cuts, right? So open is sensitive to rate cuts. Um, so 9 of the 19 officials see two additional cuts in 2025. Two see one cut, six see no more cuts. Okay, we're back to $10. So open is going to be stuck with the $10 level for now. Alrighty, back to the S&P. We're back to green, which is good. I still would like to see that thing make a brand new high, though. Can you believe we actually have a rate cut, guys? Can you believe that? My goodness. Trump eventually got his way, huh? He just had to fire a few people, that's all. Just had to fire. You're fired. You're fired. We have rate cuts. Yeah, let's go. Let's go. Let's go. You guys should be grateful to Canada for leading the way. Canada cut earlier today, and then, Powell said, you know what, let's do it. I'm kidding, by the way. Canada, anyways, I'm not going to say anything else. But we're pushing back to the high, so this looks a bit more sustainable, right? Usually it's one way and then the opposite way. We're actually holding up this time, which is good. So we're going for all-time highs now. Again, the previous all-time high was 661.78. So Kahoo, Canada. So SPY's going up and so is Open, right? Open's recovering with the S&P now, which is good. Which is good. Actually, we were 6 cents away, guys. 6 cents away from all-time highs, and then dropped. So yeah. Canada who? Canada. Last time too wanted negative rates. Isn't that the North Pole? No, that's where everything amazing begins. Like the internet. And cell phones. Yeah, and snow. Beautiful Azul. Beautiful. BMNR in the 40s. Beautiful Dipskis. Or the 30s. It's pretty close to the North Pole. Hey, you guys are haters. You guys better be nice. You got rate cuts. Now we can continue cooking here. Does anybody still believe though that, like, when he's done speaking, we go the opposite way? Buy the hype, sell the news. Like, we may be pumped today because we're getting what we expected, but then tomorrow we reverse and go down. Right. So I'm still, again, until we get through today and tomorrow, I'm still a bit skeptical. Um, Still a bit skeptical. So here's the headline. I'm not sure why it looks like that. This is basically the same statement that he's gonna read on there anyways. So I don't really care to go through it. We know that the rate cut is 25 points, right? Just looking to see if there's anything else on here that makes sense. No, 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 no. Unemployment rate, no, 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 remains. Inflation has moved up and remains somewhat elevated. 2%. This is the same rubbish that he reads every time, so don't really care for it, Don't really care. This looks a bit different than what we're used to, though. But I think they will be cautious. Now you can buy a house in Florida. Minus 25 points. That's pushing it. Yep, not complaining though. Yeah, because you have a house there already. Back to the S&P. So it looks like we're stalling right below that previous all-time high. Right, I'm gonna put a line here just so we know exactly where it's at. So that's the previous all-time high for SPY. So maybe we break above that, or we just double top. For now, this looks like a double top, right? So this level was here. If we scroll back, the pre-market doesn't necessarily count. So we hit that high at the open on last Tuesday. We hit that high, right? So again, like I said, the pre-market doesn't register. So because if we look at that, and then it's 66260, but that doesn't really matter. If we do break above this level, then yeah, we can look at that level. But for now, that doesn't count. So for now, this looks like a double top, right? Resistance, yeah, resistance, and yeah. Pizza. It's because there's nothing valuable in the document, There's nothing valuable in this document. Like zero. There's nothing there. It's all rubbish we're gonna listen to anyways. So there's no point reading that. Hey yo, humble. Let's see. Sometimes we get these headlines in the options channel. Traders add to bets on at least one more Fed rate cut this year. So at least one more. Fed median projection shows 50 basis points more in cuts in 2025. Yeah, so it looks like we're looking for two more cuts this year then. Okay. Now see, there's nothing else to this, right? So 25 points now, 50 points later on. According to what the Fed said, according to the expectation at the end of the year. So the Fed wants to be at 3.5, 3.57. So that's 50 points from where we're currently at, right? So two more 25-point cuts, and then we're done for the year, right? So again, there's nothing else. Pizza, is that what you're looking for? The information, what good are you? Is that what you're looking for? Okay, there you go. Are you happy now? Right? The magic 2%, never get there. I know. Gary, our goal is 2%, but we never get to 2% though. Yeah. Any other questions? Huh, Pizza? Any more sass from you? Um, yeah, and it fits perfectly too because we have two more FOMC meetings in 2025, right? So that would give two more 25-point cuts for the rest of the year, and then 3.5, 3.75. But that's it. So Powell is going to be on in 20 minutes, guys, and then we'll listen to him, talk about all this rubbish, and then you guys can share for Kobe. Hugh, did you make monies? So it looks like we're hitting a double top for the S&P for now. So right below that previous high from Tuesday. So I wonder if we will break above that resistance when he's on, or if we will just keep dropping. Right? Like I said, I'm not really convinced yet. I'm not convinced yet because I think we've been conditioned to believe in buy the hype, sell the news. So I don't trust any of this yet. And look at that, we just went back to red. So I am not convinced at all. Until we break above that previous high, I still expect blood. Yeah, so maybe dip now and then pump when he's on. Maybe. Mm-mm-mm. Looking for the second part. Oh yeah, the up and then the down. Oh yeah, the usual. Good. So look at that. We're dropping like like when I shoot Peter in Call of Duty and he's falling like a tomato. That's how. Yeah. Violence. So we're playing with 660 for now. I think we're gonna pick a real direction though when he's on. So maybe we just stay even for now and then reverse back up when he's on, or create brand new lows. Shed some risk, yeah. Good plan. Peter knows it's true. The poly market had been hinting at 3 rate cuts this year. La 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 la. But yeah, so 50 points, so just two more cuts. Ah. Yeah. See, open was a bit more sensitive to the cut than I think maybe we expected it to, because that thing dropped like a tomato. My goodness. From almost $11 to below $10 open. The good thing is though that it's been in this range all day today, and hopefully it closes back above $10 and then continues the run, right? But yeah, just make sure you have a plan of your own though. Yeah. Yep. Yep. Yeah, exactly, Winterfell, exactly. So hopefully, yeah, the S&P is not looking too hot. Um, we're really going down to the 200 EMA. So why not a watermelon or a green bean? No, it's either a watermelon or a tomato. Just those two. Mm-mm-mm-mm. You don't want to be dropping your green bean. Let's see. But so there's I wish I could find that chart. For some reason, I can't anymore. But so there's usually a direction that we take leading into the speech, and then we take the opposite direction. So maybe this is a good thing, right? So like I said, I'm not convinced that we're gonna pump until we break above that previous high. this isn't convincing, right? So this is just market reaction. Probably the market makers trying to scam people. Obviously the reaction is going to be good. Initially, the reaction is always going to be good in the short term, right? It's going to be good. Why? Because rate cuts are good for the market, right? But that doesn't mean we're going to keep pumping, especially when we've been pricing in the news. So this is almost what I expected. The redness, right? This is what I expected. The blood. So the only question that's left now is, will the markets reverse when he starts talking though? Because usually they do. Alrighty. For now, violence. So if you bought some zero DTE puts, you're smiling. Yeah. Did anybody buy some puts? Because that is violence. Violence. Where's virus? Virus is hiding. Hiding. BMNR is going down now too. Everything's going down, right? So everything's reacting with the markets as well. So look at Open, right? Open has been slapped as well. That's exactly what you were looking for, Hugh. One way and then the opposite way. The usual, the Hugh special. The Hugh special. Damn. Hopefully you guys took some Open is closed. Damn, pizza. That's so savage. Look at the S&P, guys. Look at that, right? We're just getting slapped now. Lows of the day. Is this a surprise? No, we kind of expected this, right? So we've been saying this all day today. When everybody's expecting that the rate cuts would pump the markets, and we've been pumping for a month now, you want to be very careful, right? You want to be very careful. Buy the hype, sell the news is a real thing. We know that too well with Dogecoin and everything else, right? Buy the hype, sell the news. Buy the hype, sell the news. So the only thing that can save us now is Powell opening his mouth and yapping. But if he says the wrong word, we're gonna have a 1% red day today. So I mean, it would be a healthy pullback. It would be a healthy pullback. But for now, violence. Open will open and slap your eye. Ah, yep. So again, have a plan for your positions, please. Have a plan for your positions, and if the markets recover, open will recover as well, right? Why is the market going down? Buy the hype, sell the news. Buy the hype, sell the news. Good afternoon, Boomski Candle. Peter, how come your head is so big in this? Huh? Why do I feel like I'm streaming on the wrong software? Anyways, no. And here comes a bit of a rebound. Look at that. So the markets are going up. Open is going up, right? Is that pizza in the profile picture? Yeah, basically. And it like yeah, like AI pizza, but really pizza. Yeah. Do. You like the hat? Yeah, it's a village hat. Peter stole that from no. So if you played with zero DTEs, guys, the FOMC is usually a good time to do that. Because we go both ways. We always go both ways. Always. We either go down and then pump, or we go up and then crash. So this is just typical, right? So that's why I kept yelling. I'm not convinced. I'm not convinced unless we break out, because the other one has to come, and here it is coming. Anyways, Come on, Powell. 12 minutes, guys. 12 minutes, and he will be on. Doo, doo, doo. 12 minutes. Mm-mm, mm-mm, mm-mm. And honestly, we might turn around and reverse the other way. We might turn around and reverse the other way. But I think that's going to take him saying some good things, or just coming on and his presence. BTC, what's BTC doing? Oof. BTC, the candles look exactly as the S&P, like they have been, since forever, you know. But rate cuts are usually good for BTC. I think once all of these things, kind of settle down, BTC will end up pumping again. But this isn't that crazy of a reaction. We're still above 115,000, right? The high was 116,200. So that's not that far away, right? The market really hasn't gone crazy. I think until he's on, I think we will just keep playing games for now. Already, like we're down less than two, less than 2 points then. So um, not that big of a deal. Uh, do, 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 do. So 2025 3.675, 2026 3.375, 2027 3.125, 2028 3.125. Uh, Seems like it takes way too long for them to get there. Just cut everything. Cut everything, please. Let's just get to 2%, We're not really asking for too much. Just cut. Yeah. Not looking too hot. Not looking too hot. We might see new lows. -2% would work. This is a massacre. This? No. This is barely a red day for the S&P. This is barely red. Do you remember the day that Trump put those tariffs on everybody? Do you remember that day? Yeah, that was a day to cry about. That was a massacre. This this is like an ice cream sandwich. This is nothing. We're not even at 1%. Remember COVID? Yeah, when the market got halted, sheesh. I've never seen the S&P halt except for COVID. We got pretty close this time, like very close, and we didn't halt. Right? If you thought this time was bad, just remember COVID. The day isn't over now. It's not. But again, like we're not even we're like this is barely red. We're down 90 cents, right? 90 cents. Like there was a day that we lost $20 this year, right? We're down 90 cents. So this is child's play. Open is recovering back too, which is nice. So that $10 magnet is a really good spot for open. So it would be good if it reclaimed that and stayed above $10, right? So, and look at this. Look at this. We're popping again, right? We're popping again. KB says, "Do not mention." Yeah, 1987 Black Monday takes the cake in your lifetime. Yeah. Yep. I think tariffs and COVID. I think those are the two that stand out to most younger people. You know. Yeah. People like Peter. Yeah. Then 1927 when Peter was walking the streets of Alabama, when spy was worth 2 cents. And then he lied about his age. He moved to America and lied about his age, you know? Where's ICE? Come on now. We need somebody to deport Peter back to the village. Take him to Nigeria, please. That's where his DNA is from. Rubbish. Anyways, the S&P is about to be green now. Look at this, right? We're down 20 cents. So again, like I said, this isn't that big of a deal. It's not like something horrible happened. The market got exactly what it wanted to get, right? So, um, yeah, so not too much. I walked shoulder to shoulder with Abraham in the Moses slides. You know, this was Peter back in the day with these slides. Yeah, these were called the Bethlehem 2000s. You know, Bethlehem 2000s, the first Nike ever to be made. You know, Peter was walking in these with Abraham crossing the Red Sea. Yep. The Red Sea in these, you know? You could walk on water with those things. Water resistance. Oh my goodness. Unbelievable. That's how old Peter is. You know, he's seen all the market crash. The stock fish stock market crash, the soybean stock market crash, everything he's seen. Anyways, the Fed is on in 6 minutes, and then and then we can listen to Powell. Ah, even back then, I made the market smart. Oh my goodness. Unbelievable. Oh, Peter showed up and the market said, "Mm-mm, not this guy. We know him. We've had some history." Ah, he saw the great salt. Ah, anyways, open is almost back to $10 now. So that's a pretty good rebound. Good scalp piece. Like if you bought the dip there, right? Good little scalp piece. M5, yep. Let's go, Archer. Yeah, did anybody catch the dipskis there for some zero DTEs? Are you done for the day, Hugh? You done? You need to stop adventuring, Hugh, and come join us in the options cooking lab. You know, come cook some spy. BTC is pushing back up as well, right? So the entire, everything seems to be recovering now. So almost back to 116,000 for BTC, and then the S&P is almost back to green, right? Down 20 cents. And so Powell is on in 4 minutes, and then we'll listen to him yap. Hopefully he doesn't ruin it. I really don't want to see brand new lows of the day, but who knows? Who knows? ATCH has done really well today with at least the comeback. Yeah. I like it. I like it here. Yeah. So we're either gonna break above that previous high or we're gonna break the bottoms. Right? Yeah. Let's go, Hugh. Yeah, come back, come back, come back. We need more chaos from you. It's good to see you though. Jeff, are you sure you want that? Are you sure? All you need is Peter to buy a stock so it can go to zero and then you can buy it, then it comes back. Yeah. ah. Let me pull up the Fed website here. Oh, look at that, guys. We're back to green. You can hear that, right? So that's the Fed piano music. So obviously he is not on yet. So we're just gonna wait. And the markets are back to green. Back to green. Open is back above $10. Bitcoin is back above 116,000, right? So everything is okay, guys. Everything's okay. Everything's okay. So now the true direction, though, the true direction will be when he's on and we either break above that top. If we do, it's pumping from there. If you hold puts, you pray to your ancestors, they won't even listen to you. Okay, so if we break above that high, that's your direction for the upside. If we break above that last low, pray. If you have calls, you better not go to your grandma's house this weekend because they're gonna ask you how the stock market is doing. You better tell them you suck. Okay, so we break that bottom, you better not be in calls. We break that top, yeah, you better not be in puts because you'll be entered. Alrighty, so now we're basically sitting in the middle here. So that's the only way we pick a direction today, by breaking that previous high or breaking the bottom. I'm excited but scared. And here we go. Okay, I'm gonna reshare. It's gonna mess up my thing again, but 1 second. So there's that, and it's loading. Loading, loading, loading. Loading, loading, loading. Do I need to refresh this? Or is it still the music? Okay, well, looks like the door is about to open, you know? The door is about to open and he's going to say good afternoon. My colleagues and I, yeah. Vivek was already stretched. Jeff. Here we go. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry. Can you and other Fed officials have spoken extensively about the impact of tariffs on inflation. Although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
It's certainly possible. We're beginning to see, we have begun to see goods prices showing through into higher inflation. And actually, the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point. And we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when we feel that policy is
What's happening?
a place and needs to move quickly to a place. That's not at all fate and see.
That's not me, guys. It's the website, the Fed website. No, this has nothing to do with me. You could tell, no, if it was, you wouldn't be able to hear me. Let me refresh it. Let me quickly refresh it.
A place and needs to move quickly to a place. That's not at all fate and see.
Yeah, that's almost like the stuff is glitching. Right? You can hear me fine. Almost like the tape is glitching or something. Someone's attacking somebody. Uh-oh. Someone's attacking somebody. Well, the S&P looks like rubbish though. We're hitting brand new lows. Never forgive Canadian Wi-Fi.
In place. I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP,
This is kind of annoying, isn't it? Kind of annoying. Yeah, you can tell when I refresh it and it goes backwards, it's something that's wrong with their stuff.
in place. I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP,
You see what I mean, though? Like it goes, it resets, and then it just goes back to like loading.
actually, the projections for growth next actually ticked up just
This is annoying. This is the first time it's happened. A little bit annoying. Well, that doesn't help the S&P though, because we're still hitting brand new lows, right? So like I said, if we're breaking the previous low, you don't want to be in any calls because you're going to be crying, right? So exactly kind of what we expected. Everybody's like, oh, rate cuts, go boomskis. No, kind of doesn't work. Pizza. Yeah, new lows. When you're trying to watch a DVD and like there's a scratch in it and you're waiting for the scratch to be over? Yeah. That's kind of what's happening there with Powell. And then if I refresh it, it just goes back to like, which is annoying. 50. No one watches DVDs anymore. Yeah. What's a DVD? See, right? Like, doesn't that look like a scratched DVD or something? Is it happening for anybody else? Let me just refresh this again. One last time. See what it does. Okay, I'm just gonna refresh the whole website. That's it's happening for you too. Yeah, see, like it's the Fed. They run out of money. It's happening for me. Yeah, so it's happening for everybody else. So it's something to do with like what they're doing. Yeah. Yeah. See, I don't know. Yeah. Yeah, I don't know, Lisa. It is the Fed site. You looked on other places too, Willie? Yeah. If it was my issue, I think like you guys wouldn't be able to hear me, like I would definitely have a problem. I think what they wanted was to pause this so no one could hear it and then crash the market. Right? So once we break below that low, you definitely don't want to be in calls because you're gonna get destroyed. Yeah, see? Yeah, the weird part is like I'm clear, but they're not. So this is the best your stream has worked. Yeah, the markets are getting slapped. We're gonna go yeah, maybe I'll try that, Yogi. Let me try that instead.
Forecasts say that. We can't just assume that though, right? We have to, our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has.
Okay, I'm gonna switch it. Let's switch that. Let's use the other side. This should work.
Mandates, and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation.
Okay.
How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market. And so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market. And obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins. So kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. You know what? Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low, and when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk, and that means there's no risk-free path. And so it's quite a difficult situation for policymakers, and it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right there that it's a wide dispersion that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 0.25 percentage point now is going to arrest that?
Well, I didn't say that I thought a 0.25 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minority unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together and we see that the labor market is softening and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is? And what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us. And we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy is growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
I'll follow up if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and, business investment. So we watch all of it. And I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
You know, housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates. And that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think this default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape. Banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run, they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations, both break even in the markets, and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals. And so we have to balance those two. When they're both at risk, we have to balance them. And that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right, guys. Well,
So there goes your new host. All right, guys. All right, guys. I have no idea who that is, but he's quite the guy. Oh, I have no idea who that is. Yeah. His name is Steve. Okay, I have no idea. Bilal, there's nothing to be explained, right? There's nothing there. At least we got to hear the conference. Yeah, that was good. For some reason, the Fed website wasn't working, so it's good that. Thank you for the link, Yogi. Any questions, guys? So obviously the S&P is, we've had some like crazy reactions, right? Up and down. Honestly, like when it comes to the Fed meetings, like the most information we get is from that initial statement, like the Fed's cut rates and we expect this and this as the year progresses. Other than that, like these questions are for the most part just really repetitive, Yeah, we know everybody's struggling. We care that everybody's struggling. You can't buy homes. Too bad. Suck it. But like in a really nice way, like a really nice way. Yeah, the rates are too high. How about we're doing the best we can? That's kind of how it sounds, isn't it? It's like that every time. So 25 basis points cut, that's what the market was expecting, right? The Fed is saying that they're wanting to get to like 3.5, 3.75 by the end of the year. So that means another 25 cut twice for the next two Fed meetings, right? So cut two more cuts. It's kind of the expectation, right? Other than that, like nothing else really matters, right? Suggest no, lots of same questions. Yeah, exactly, Elisa, right? It's all the same question and it's all the same answers, right? So he's either gonna say like circle, 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 we don't care, or circle, 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 we're gonna do what we want. So yeah. Negative information out of Powell, which does not help the market at all. For these calls. Absolutely, Lauren. Absolutely. Yeah, we always listen to these calls just because, if something does happen, we want to know what's happening. And also this really affects people, right? So, yeah, honestly, Coma, I have no idea. I have no idea. So, yeah. The next Fed meeting is in October. So probably like the end. It's like so yeah, and then there's one more at the end of the year. Is it October or November? So like almost every 6 weeks, Subois, and then then it's done for the year. Obviously, Open reacted to that and then recovered, right? So if you bought the dipskis on this, congratulations. That was a pretty nice bottom on Open, actually. Look at that, right? Double bottom, triple bottom, Open, $9, boom skis. So again, obviously we knew this would be sensitive to the rate cut, right? Because Open kind of deals in that market. Housing. VCIG had some news not that long ago, and the stock exploded. So from $9.50, $10 all the way to $15.40. So that's a pretty big run. Congratulations if you FOMO'd and sold. The S&P's recovered, guys, right? Like there was nothing negative there, right? Like there's nothing negative. Our concern is all the good news priced in, right? That was our concern, not that there was anything negative coming today, and that's exactly what's happened, right? So 25 cut expected, priced in, good thing for the market, right? We had a pop and then we crashed all the way down, right? And then we recovered because again there's nothing crazy here. So I think into the end of the day and then tomorrow I think I think we should have another big like reaction one way or the other. Yeah, usually the day after is interesting, after the Fed is interesting. So we'll see. Good bounce though, really good bounce from the bottom. Any questions, guys? Any questions? La 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 la. Willie? Yep. Yeah, we talked about that. And the markets close in 30 minutes, so 30 minutes. So we can hang for a bit and then go back to Discord. But yeah, I'd like to see the S&P make brand new highs. So we've already made new lows. So hopefully if you had puts, you locked in your gains. Now let's break above those highs, please. All-time highs? That would be nice. Can you believe we were at 654 all the way back to 660? Craziness, huh? Not today. Not today. So VCIG is halted down, sorry. And then open is, you can kind of see that supply zone around 10:30. And then BTC is still in the same range, just like SPY is. Other than that, everything else is not as exciting. Not as exciting. Let's see. Not as exciting. Anybody looking at any swing plays? Tony says, one-on-one strategy saved me so much monies from being lost all week. Good. Good. Good, good, good. Good, good, good. No, the one-on-ones are amazing. The one-on-ones are amazing. At least we just get to have a conversation and figure some stuff out, Yep. Is it a good time to sell or should you hold? Safi, what's your position in HUT? Let me know. What's your position? Thank you, Cueto. Thank you. Yeah, of course. Yeah. It's always good to watch this and have a conversation about it, You've been sitting on your hands, Jeffrey. That might be a good thing. 0 trades, that's okay. If you don't see anything good, then that's fine. Let me take a look. HUT. So you're in at $35. You agreed on that position then. So you're wondering if you should sell or hold? We at all-time highs? Yeah, that thing has been cooking. You're looking at a stock that's done a split and is retesting a supply zone. Right, so you're clearly pushing for resistance at $40. So your resistance is going to be at $40. So then you're wondering if you should sell or hold. I would say for now, if you have a big position, you should probably consider scaling out. If your position isn't that big, I would honestly just put a stop loss above 35 and hope we break above $40. Especially if BTC cooks after the rate cuts, then you're going to be really happy. But for now, though, if you have a big position, clearly you're at resistance, consider taking some gains, right? If not, put a stop loss above your entry price and guarantee to walk away with some gains. The S&P is going back for red here. Alrighty. Guardian says, can you take a look at ATCH? But you're interested? Okay. Sounds good. ATCH. Risk off but interested. This one's weird because we're in the middle of the range here, that answer would have been easier if we were closer to $1.35. But we're in the middle. So if I was interested in this, one of those, we either need to dip closer to $1.35, Guardian, right? Or break above $1.65, that's an option. If we break above $1.65, you might just push to 180. Then if we break above 180, then there's a lot more room to the upside. Alrighty, so those are the 3 levels I'd be looking at. So closer to $1.35, break above 165, or break above 180. Yeah, perfect. SPY, what are you doing? Can we go the other way? Can we go up instead? Can we go up? SL and H and GPUS. Can you give me your perspective? You're thinking of swinging those plays? Sure. It's the SL and H. You're looking at this as a potential swing play. It's not a bad swing play. That's the 50-minute chart. It's not a bad swing play for now, only if you stay above 90 cents. So if it stays above 90 cents, I don't mind. Your resistance is closer to $1.10, so it needs to break above that. But yeah, you need to stay above 90 cents though. So whether that's now in after hours, blah, 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 it would be nice if you stayed above that level. Let me look at the 30-minute chart here. It's going to be the same story, right? Same. You need to stay above. Yeah, the 4 hours is a bit more dangerous, isn't it? Right, because you can see that this thing has had a pretty big run, big run, and then stalled at 110. So just make sure you keep a close eye on it in after hours. Alrighty, and then GPUS as a potential swing play, probably gonna be a bit more, a bit more suspicious. Yeah. Hmm. I know this one had that big run, which we had a lot of fun with, and then it came back down. But you can also see here, though, that like this one's been holding. So these are daily candles, by the way, right? So this is like a week and a half of data, right? And you can see that it's been holding 37 cents. So you're at 40 cents. The all-time low is almost at 37 cents. So if you're gonna swing that, that's fine. Just make sure that it stays above 37 cents. Cool. Okay, moving on. SPY's looking a bit more suspicious there. Obviously, that's taking open with it too. VCIG is still halted down. And speak of the devil, look at that. Slap. 1170. And back to $12. Yeah, these candles are crazy like this because they've just done a split, right? They've just done a split, so the float is going to be super low and the stock is going to be extremely volatile. You're welcome. You are welcome. I'm surprised they didn't halt it on the on that drop there. Foosball, what's your position for Link? What's your position? Help me out. Had 1,000 shares of Palantir at 7, sold at 23. Sheesh. I mean, to be fair, there were a lot of people sold before we got to the highs, you know? Lots of people. VCIG is trying to rebound here, so that's good. So $13 and back down. $13. ECIG. Your position is 1057. Okay, perfect. Let's look. Link. I'm looking for the one on Coinbase. You're in at 1057. Sweet. Some of the stocks in the market are looking for Link Treasury, so I'm sure that helps a bit. You clearly have a lot of resistance at 27, though, as you can see, right? Foosball. A lot of resistance at 27. Like this thing was stalling all of the last 3 weeks. This 27 has been a problem. And if you go to the left hand side, you go back all the way back to like March, the beginning of the year. You can see that same 27, right? Like this level has been a problem forever. So for now, it looks like you have a bit of a problem there. I'm sure this is a long-term play for you, and that's most likely why you've held for so long. You've doubled your money in this though, so congratulations. Your next support is 22. So if you can stay above 22, I think you have nothing to worry about. If you break below 22 though, then you might be looking for 18. Alrighty, for now, meh, you're fine. Right, so it's been holding this level, this 22 level for quite some time now too. Like the last month, it's been holding it. Right, so as long as we stay above that, but you also have to know that 27 seems like it's been a problem for months now. So if it ever breaks above that 27, ooh wee. What's crypto doing on the screen? I know, right? But yeah, so yeah, your position's nice though. Congratulations. Monies. SPY just kind of seems confused. Like it just wants to close around 660 and be done. Like, just give me 660. I'm done for the day. It would be nice if Bitcoin closed above, 116. Yeah. And then cook from there. Cook maybe tonight. Maybe tonight, Gary. Pump it. Pump it. All of that chaos just so we could end the day at break even, The market makers always win. They're like, you hold puts, I hope you took your gains. You hold calls, I hope you took your gains. Because we're going to destroy everybody. Destroy everybody. We'll try and hop off right before the market closes, guys, so we can go back to Discord and look for some, look for some after-hour plays, See what's cooking. Yeah. 119,600 on a long. Okay, like a leverage long. Are you still doing those, Gary? My goodness, I got liquidated, and I was like, nope, we're not doing this 100x. Yeah. The market makers, what a great gig. Yeah, Yogi. Yep, the money's and the friends. 3x. Okay, that's not too bad then. Yeah, that's not too bad. Remember the days of 25x, 50x, 100x? Yeah. Let's go, Josh. Ayo. So it looks like yeah, we might just kind of hang around this 660 level for SPY, right? And then figure out the rest tomorrow, which is okay. With the dark pool. Yeah. I mean, someone has to make the game, Someone has to make the game and rig the game. But yeah. As long as we don't do anything too crazy, we also win. Just a side note, Pengu looking nice. Yeah, I'm sure Josh is watching that. Has a few weeks now. Yeah. Can I take a look at SQFT? You're in at $9. Interestingly, it's up here. $9. This one seems to have a lot of resistance up here. A lot of resistance. A lot of resistance here. At 950, 940. Your entry isn't bad though. Your entry is like in a little suspicious area, Savoie. Like a little suspicious area, but it's not bad. If you can get a break above 950, I think you're going to be pushing for 10, obviously. But yeah, you need to clear this little supply zone. So if I highlight those candles on the left, you can clearly see a supply zone, right? Like it's been failing at this level like the entire day now. So 940 to 950. So you just need a break above that. I honestly, again, so your support is all the way down there at 850, but I don't think I would let it go this low. So that's been the range the entire day, right? 850 to 950, right? 850 to 950, 850 to 9. Like it's just going up and down. So for now, technically, if it stays above 850, you should be okay. So just make sure that it doesn't go above that level. I don't think I give it that much room, but just in case. SPY's going back for that 660, which is what we kind of expect. Right, and here it comes. Here it comes. Can we close at 661? And then I highly doubt it. We're either going to close right at 660 or below. La 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 la. As a la la la, do not buy it. Interesting. Interesting. Open looks good. I think open closing above $10 is nice. Yeah. I think open above $10 is pretty nice. Anybody swinging open? Probably. It does. It does. I mean, we were above, but the last few days that level's been quite interesting. But I think this is a pretty good comeback though. So it looks good. Looks very, very good. Mm-mm-mm. And then we just need Josh, to make that phone call so BTC can go back to 117 tonight. Because we've been chilling too much at 115 today. It's like all day today. At least we're away from the 110s, the 109s. Those were a bit scary. Those were a bit scary. Okay. You almost own 0.01 BTC again. Beautiful. Beautiful. Okay, let me get rid of link here. Go back to ATCH. Yeah, ATCH doesn't look bad. I think you just need that thing to actually break out. So again, 165 and then 180-ish. Imagine a world where it hands you then you put check on hold. Oh. Oh yeah. That's so stupid. Like the check is from them. Like how do you put it on hold? How does that make any sense? Did you call them, Josh? Like, hey, you guys gave me this check and you're putting the same check on hold? That's so stupid. So stupid. Well, those are the banks. SPRC. They don't trust their own monies. Look at SPRC, guys. That was a nice pop. A nice pop there. That 450 resistance level from earlier today too. BMNR. BMNR. Breakout. In our accounts, yeah, kind of annoying. Can you imagine if they gave you the monies at 107, 108, 109? Instant gains. Instant gains. BMNR. Yup, see why I'm pissed at them? Yeah, for sure. Those would have been really nice gains. Yeah. Yep. Now when cross 60 is the question. Now when 60. No, when 100 is the question. Yes, please. 12 minutes to go before the close. Hopefully, now that we're done with the Fed meeting, we can have a 500%, 1000% runner tomorrow. Can we do that? EDUC looks like it's pushing. EDUC, educational development. Nice little push there. I think needs a bit more volume, but yep, needs a bit more volume there. Needs a bit more volume. Interesting. And here goes another test of 660. So we're either going to close at 660 or like below. Nothing too crazy above. Nothing too crazy above. Don't forget to smash a like, guys, if you haven't already, please and thank you. Take a second and smash a like. And hit that subscribe if you're new to the channel. And if you're not a member yet and you want to join us in Discord, Willie, I'm kidding. Click the link at the bottom of the chat there from Nightbot and come join us. Alrighty? Come join us. $59.70 again. 919 665s. Okay, so this Friday is 665. Okay. Dang, Josh. Dang, you're looking for some cooking. That's what you're looking for. Looking for some cookings. 58 cents. Okay, that's not bad then. It's not bad. Yeah. Yep. I still see the markets being suspicious, but SPRC is testing that 450 again. So if it can actually break above that level, maybe after hours is going to be fun. No. Yep, 450 resistance, Salat. EDUC, nice pop. Just super slow. Super slow. Open is actually doing okay. No crazy fluctuations below $10 anymore, so that's good. Nothing crazy. No. Okay. Interesting. Any last questions before we hop off, guys, and go back to Discord for after hours? Any last questions? Let me know. Let me know. Let me know. Take a look at RR. What's your position in that play, Slaps? What's your position? Let me know. Take a look. I usually ignore these questions because there's nothing, other than just look, any more than that, usually. What's your question here? Because that thing looks like it's sitting at resistance, right? Because it's been pumping and pumping and pumping, and now you're sitting at a double top. So 420, 450 resistance, and then 520. Josh, have a blessed evening as well. Don't sleep on a good opportunity. The future's bright. Let's go. See you in Discord, Tony. Yeah. Do you think do I think it's gonna keep pumping? Only if you break above 420. So I would stay away till that thing breaks above 420, and then you can look for an opportunity there for a push to 450, and then if it breaks above that, then maybe 520, right? So just again, look at this, right? It's been pumping, right? So you kind of missed this entire thing. It's been pumping, and now we're kind of struggling at resistance. So you need that thing to break above. I say 420, but it really needs to break above 425 first. So that's the high from yesterday. Today it couldn't do it. 425 was the high from yesterday. 424 was the high from today, right? So there's clearly something there that it needs to break above. So if you're that close to resistance, you're better off letting it break above. You're holding. You just said you were looking for a position. Now you're holding it. You know what? Slaps. That's your last question. Keep those questions to yourself until you become a member. See you in Discord, Courageous. One more look at open. Yeah, of course. Yeah, open for some reason just doesn't, like that supply zone. I like it though that it's like holding above 10. So if you can stay above 10, Jeffrey, I think you're okay for now. And then 1030, 1035, and then 1070, and then the actual 52-week high, 1087. Yeah, I mean we did push. We pushed above 1070 and then 1087. Right? But then we had the Fed, right? So then look at that, right? Slap with the interest rate cuts, right? And now we're trying to recover again. So plus long term, okay. Sounds good. Alrighty, y'all. We will leave it here for the day. Have a wonderful evening. Be safe. We're gonna continue in stock general, and Hong Kong Police Department's cooking again. So, alrighty. HKPD with a nice little pop. This thing runs every so often, It's almost like they're really chasing criminals for real. Every time there's a criminal, that thing runs. Elisa, thank you. CMC foosball. See you tomorrow. Have a wonderful evening. Don't forget to smash a like before you go, guys, and hit that subscribe if you haven't already. And yeah, if you do become a member, Gary, good to see you as always. The Fed brings you, if you do become a member when the stream's done, send me an email, HotTradeX, or your invite is going to be in the community section on YouTube's. Alrighty? Be blessed, everybody. Thank you very much for the support. And be nice to one another, please. And yeah, see you guys later. Bye, guys. Bye, Shima. Bye, Savoie. Salat. Bye for now. Bye, everybody. With Web3 stuff? Okay, Gary. Yeah, it's good to see you. Yeah, bye, guys. Bye-bye.